Live from Bloomberg's world headquarters in New York, I'm Scarlet Fu. Tim Stenovic is off this week. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance. Crypto takes it on the chin hard. In a span of 24 hours, the combined market value of all cryptocurrencies tumbled by more than $150 billion. We will dig into the fallout. The return of Zach Prince, co-founder and former CEO of BlockFi, which filed for bankruptcy after the collapse of FTX. Prince is now leading a new banking platform at Galaxy Digital. We talk to him in just a moment. And we'll also be speaking with Neha Narula. She is the director of the Digital Currency Initiative at the MIT Media Lab. She will discuss the increased institutional adoption of digital assets, and that is all ahead in the program. Now let's start with a snapshot of Bitcoin's price action. Going back about 6 days to last Friday, you could see the big drop off there. We saw a historic round of liquidations triggering a sharp sell-off over the weekend. Trade tensions weighing on not just cryptocurrencies and Bitcoin, but all risk assets. But it wasn't just the original cryptocurrency that declined. Here's Ether, which has fallen from its August peak by quite a bit. You can see erasing billions of dollars in value. It is now down around 18% from that record high back in the summer. Now, we caught up with Yat Siu. He is co-founder and executive chairman of Animoca Brands earlier this week, and he shared his reaction to this weekend's crypto sell-off.
I think what happened over the weekend was a little bit of a shock. This is the biggest sell-off, the biggest liquidation in the history of crypto. There's been a lot of liquidations. The prices have collapsed, momentarily, in some cases going down to sort of like literally sort of 70 or 80% drops, but for a moment. And of course, that forced liquidations across the board. And a lot of people, even who thought they were relatively safe with their sort of, position.
Bloomberg News has been reporting on these historic liquidations in regards to concerns about the centralization of exchanges and the damage done to altcoins. Lauren Taralacapra is tracking the story, and she joins us now. So, Lauren, we've had a couple of days to kind of see the dust settle. What are your big takeaways from these forced liquidations, this horrible sell-off?
Yeah, the sell-off really exposed some fragility in the market structure. Some of these trades were automatically liquidated. It wasn't like the traders chose to. And in particular, Bitcoin, Ether, familiar names, but some of the altcoins really took it on the nose. I mean, just huge drops in them, and really make investors wonder whether they should even be in that area of the market at all.
What are people saying about whether those smaller altcoins can survive what happened this past weekend?
Yeah, I mean, there are some doomsayers that just think the market won't come back, but people say that sometimes and it does come back. So there's a lot of enthusiasm around it from some of the true believers and kind of the wacky coins. But I do think that some of the market structure issues are going to stay with us for a while. And there's talk in Washington about making potential changes as well. So I don't think this is the end of the story.
I guess there's a lot of question about where is the structural support for some of these smaller altcoins, these tokens, where maybe there's not a fundamental reason to be in them.
Yeah, that's exactly, you hit it on the head, Scarlett. I think that's a big issue with it. It's also, when there's not a lot of liquidity in those coins compared with Bitcoin, you're naturally, as a trader, going to be more at risk. So investors need to keep that in mind.
Here's the other thing. We chalk it up to President Trump's threat of these massive tariffs on China, which he later revealed to be 100% on Chinese imports, and this overall flight out of risky assets. We certainly saw stocks tumble. Was it just that, or was there something specific within the crypto universe that caused the sell-off of this scale?
Yeah, I really think it was some of these dynamics where margin calls in crypto are not the same as margin calls in other traditional markets.
How so?
They don't really ask you, do you want to put up more collateral? They just get automatically liquidated. And so some of these positions that people might have wanted to hold on to, even if it costs a lot of money, just got wiped out. And that's where you see the record liquidations on Friday and Saturday.
I also saw in your reporting that Binance said it's changing the way that it prices some tokens, and that may have contributed to some of the price action.
Yeah, there were some issues with pricing as well. Binance made some statements about that. I believe Coinbase did also. I mean, they were getting widespread criticism, publicly on these forums and social media about what had happened, with traders not able to see even what the pricing was or getting incorrect prices. So the exchanges had to go back and repair some of that damage that they caused.
All right, Bloomberg Crypto reporter Lauren Tara LaCapra, thank you so much setting the scene for us here. And of course, our next guest just joined Galaxy Digital as head of Galaxy One. Zach Prince was founder and CEO of BlockFi, which is a retail-focused wealth management platform that filed for bankruptcy after the collapse of FTX. And Zach joins us now. So Zach, I want to get to what you're doing at Galaxy One in just a moment, but I want to get first your take on the crypto crash over the weekend. What is your read on it? And I wonder if you think it's run its course.
Look, I leave the day-to-day market prognostications to folks who are more adept at that than I am, including Mike Novogratz, the CEO of Galaxy Digital. But what I would say is what we saw on our platform at Galaxy One, which just launched a week ago, is that this was a buying opportunity. Crypto is a volatile asset class, as folks know. We support Bitcoin, Ethereum, and Solana on our platform currently. So there was definitely a dip there, but the activity that we saw was that folks were using it as an opportunity to add to their positions.
There were 3 exchanges responsible for the bulk of the $19 billion in liquidated leverage bets wiped out by late Friday. The lion's share were on Hyperliquid. There was about $4.6 billion on Bybit and about $2.4 billion on Binance. So there's a little bit of irony here, I guess, Zach, in that a lot of the trading activity in decentralized finance, crypto, was so concentrated, centralized on a handful of platforms. What do you think of that?
I think that you're going to continue to see an evolution in the crypto market. There's always these moments in time where folks kind of realize there are things in traditional finance that might be valuable. For example, circuit breakers, or y'all were just touching on the ability to, give clients the opportunity to post more margin before auto liquidating them. And so I think folks have to be really thoughtful about which platforms they choose to trade on. I think they have to be thoughtful about how they're using leverage, if they are using leverage at all. And I think that the space that we're heading into with Galaxy One is more targeted towards a mass affluent investor. And as a result, we're going to be a lot less focused on anything that would fall into the category of super high leverage or kind of casino-esque type trading. And that's what I recommend to my friends and family that are participating in the crypto market as well.
So let's talk about Galaxy One. With all the digital banking platforms out there, why Galaxy One? Why does Galaxy need to launch one as well?
Well, there's a lot of benefits that launching Galaxy One will bring to Galaxy Corporate. But in terms of investors considering trying our platform out, I would highlight that we have a lot of really great products in a single, easy-to-use app, and also that we're bringing the institutional quality in terms of customer service that Galaxy is known for to individual investors. So when we launched the platform a week ago, we came out with 4 products. The first is a FDIC-insured checking account with a 4% yield. The second is our premium yield product, where investors can earn 8% on their cash if they are an accredited investor. We also have a brokerage account where you can buy and sell stocks commission-free, and of course a crypto account where you can buy, sell, and transfer blue chip cryptos. So being able to do that all in one place with the particularly differentiated product of premium yield, which we're only able to do because we're connected to Galaxy's institutional infrastructure, is where we're starting and the kind of theme that we'll continue to play on as we develop the platform.
You talk about that connection to Galaxy Corporate. Does Galaxy have plans to apply for a trust charter or banking license in the U.S.?
We have a number of regulated entities already within Galaxy. We also have partnerships on the Galaxy One app. Like, for example, the checking account is offered in partnership with Cross River Bank. That's how we have the FDIC insurance. But I'm not really at liberty to talk about future plans for regulatory structures that Galaxy has. But what I can say is that we are going to be doing things in a regulated construct, kind of inside the box. And really where we're focused at Galaxy One is the intersection of traditional finance and crypto. And as a result, we're going to be operating in a regulated world.
Galaxy was an early investor in your company, BlockFi. So you and Mike Novogratz of Galaxy kind of go back. How has Galaxy's approach to the crypto industry, Mike Novogratz's approach to the crypto industry, evolved since those early days of working with him?
Well, they've had a ton of time to operate in this market and to develop an incredibly strong risk management infrastructure that has enabled them to operate through multiple market cycles now. Additionally, the company recently went public, which has given them more exposure to all types of investors, but also importantly, access to capital markets and structures that aren't available to privately traded companies. And when you think about the scope of what Galaxy is going after, not only with its institutional crypto financial services, which is a well-known leader for, but also the data center development and the data center business that Galaxy has now, and Galaxy One, we're expanding into the retail market. Being publicly traded and having the operating history that Galaxy does, I think puts them at a strategic advantage in the competitive landscape.
I mentioned how you co-founded and ran BlockFi, which filed for bankruptcy after the collapse of FTX. Can you talk about what you learned from that experience that you bring to the table at Galaxy?
I learned a lot. I obviously learned a ton about the importance of risk management, and being able to rely on and get leverage out of the risk management infrastructure that Galaxy's built over a long period of time has been incredibly valuable already. But we also learned a lot of really great things at BlockFi in terms of how to build a large business in a relatively short amount of time that we're also bringing to Galaxy One. And the key thing I would say there is we have to build products that are differentiated and that help our clients grow, manage, and develop their financial platform and their net worth in ways that they aren't able to do elsewhere. So we were the category leader at BlockFi in lending. We also launched the world's first Bitcoin rewards credit card. And here at Galaxy One, we're launching 8% premium yield, but we have a really exciting product pipeline where we're going to be launching new products in categories like asset management, trading, and also, of course, lending, where I think we're going to capture that kind of first mover advantage and clear differentiation with a value prop for our clients that BlockFi did really well in a few areas.
All that depends, of course, on regulators giving their approval, like the SEC. Of course, the mood in Washington towards crypto has changed completely. It's a 180 from what it was just a year ago. Is, from where you sit, the SEC all systems go, green light for everything, or has it shown any bit of reluctance or perhaps hesitation on any initiative within crypto?
We haven't experienced any hesitation with the products that we're offering today. Our 8% premium yield product is actually a Reg D 506C securities offering. It fits squarely into a box that, crypto, but primarily fintech companies have gone down before. And for the products that we're launching in the future, I'm excited to have the support. And just qualitatively, what I've heard from the folks that are in those conversations at Galaxy is that it's just a much more constructive environment. The regulators want to talk. They want to be supportive of the industry. They want to find solutions, not just at the regulatory level, but also at the legislative level, which is even more important.
All right, Galaxy One's Zach Prince, thank you so much for joining us today. Coming up on Bloomberg Crypto, tokenization company Securitize said to be in talks to go public through a SPAC with Cantor Fitzgerald. We've got those details next. This is Bloomberg. Securitize, the leading company for asset tokenization, is in talks to go public. Bloomberg's Crystal C reported on this and joins me now from London. So, Crystal, give us the details. What do we need to know about Securitize?
Hey, Scarlett. Securitize is a tokenization company. We reported that it is going public through a SPAC, a trend we haven't seen in a long time. The deal will value Securitize at over $1 billion, and it will be listed in the public market after.
And what's the benefit of Securitize going public versus staying private?
So it definitely is about gathering capital. With a listed vehicle, they have a lot more flexibility in raising equity. The interesting about Securitize is that it actually is a vehicle or a company that is trying to turn illiquid asset in the traditional sense. For instance, think of like the KKR private equity fund or some sort of private equity fund that usually you cannot trade like a liquid asset. And with the tokenization, you can trade the exposure of these assets. So for this kind of company to go public in the traditional way, in a traditional equity market, that is giving a lot of testament to us how they think about the equity that will be available to them.
And you mentioned this would be through a SPAC, those special purpose acquisition companies, a SPAC that was started actually by Cantor Fitzgerald, which has a vested interest in the development of the crypto industry.
So Cantor is a very interesting company right now. It's at a very critical spot within the crypto industry. They really have built out the crypto investment banking coverage team. And with Hal Lutnick being in the administration and Cantor Fitzgerald, the investment bank being run by his son, this particular SPAC, it actually counts Brandon Lutnick, the son of Hal Lutnick, as the CEO and chairman. The company, Cantor, is also very close to Tether, and so there is a lot of their exposure to crypto that Cantor is in right now. They've actually raised 4 SPACs, and number 1 has already announced a deal. This we are expecting some sort of announcement in the near future, and we could see the remaining 2 potentially also going into something in the crypto world, but we haven't heard much on those yet.
Now, you mentioned that we haven't seen this trend of companies going public through a SPAC in a while, back in the days, in the middle of the pandemic when it was really the trend. If Securitize moves forward with this, how quickly could it be publicly traded?
So we don't know when the announcement is supposed to hit, but traditional sense is that SPAC is actually a way quicker avenue towards the public market than a traditional IPO. With the IPO, you have to go through your roadshow process, you have to go meet all the investors one-on-one, and you have to go gather your book for maybe 5-6 days. But with a SPAC, you really just strike a deal with the SPAC. You have one counterpart instead of maybe 200 potential investors. So this is potentially a quicker avenue, but whether this will attract any regulatory scrutiny, it would remain to be seen, but today's environment is much more relaxed than it used to be. So we could see how SPAC and crypto together, it could still be fun as a public company.
Yeah, it'll be quite the combination. All right, Crystal C. joining us from London. Thank you so much. We want to give you some breaking news here. Argentinian bonds are jumping on reports of larger U.S. aid. Scott Bessent, the U.S. Treasury Secretary, says that the U.S. action will now total $40 billion for Argentina. So we're talking about a $20 billion facility in addition to the $20 billion swap line that was already announced. All of this is according to Semaphore. So again, Argentinian bonds jumping right now on reports that the U.S. is ready to expand its aid to potentially as much as $40 billion in total. We'll keep you posted on further developments. Now, coming up, it's been a watershed year for crypto, especially with new regulation in the U.S. But our next guest says a lot is still missing from stablecoin regulation. Neha Narula is director of the Digital Currency Initiative at MIT Media Lab, and she joins us next.
A lot these days about in this short term right now, the debasement trade. And it's kind of extraordinary to hear Bitcoin called a safe haven because, of course, it's still a risk asset. So I think you're seeing more and more signals of institutional adoption. You're seeing really a whole crypto economy and even a Bitcoin economy emerge.
That was venture capitalist Katie Hahn speaking to Bloomberg Crypto last week. Joining us now is Neha Narula, director of the Digital Currency Initiative at the MIT Media Lab. She is also on the board of directors for Block and the Innovation Advisory Council for the New York Fed. Neha, welcome to Bloomberg Crypto. You heard what Katie was just talking about there. Bitcoin and crypto did not prove to be much of a safe haven on Friday and over the weekend. From where you sit as an academic, how are you thinking about crypto and the idea that it is an undisputed winner in this, trend to de-dollarize, if you believe that that's what's taking place?
Well, I think this weekend we learned a lot. And a lot of what happened this weekend comes from the fact that this is incredibly experimental. We are still figuring it out as we go. Crypto is still a little bit of the Wild West. But I think what's actually really impressive is the way that we saw a distinction between what happened on chain and what happened in centralized exchanges. And it seemed like what happened on chain, it was definitely very difficult for people. There was a big crash, but it worked. It continued to work. Nothing really broke. We didn't, people lost on paper $19 billion, and we weren't talking about bailing anyone out. We weren't talking about having to revert things. It's kind of impressive the way that what's happening in crypto right now proceeds, and there's experiments and they happen and we work through them. As an academic, I would love to see a bit more of a focus on users and a bit more of a focus on value driving use cases rather than speculation. But I think we are learning a lot as we go.
Yeah, the fact that it continued, there was some pain, but nothing broke is certainly encouraging. When you look at stablecoin regulation, of course, we had the Genius Act that was passed to regulate stablecoin overall. You still see a lot of areas that, frankly, we need to still fill in. What is the biggest glaring hole right now?
So I think the biggest glaring hole is probably about how we're going to make sure to enforce par value exchange with stablecoins. Stablecoins have what we call depegged. So you expect a stablecoin that represents $1 to be worth $1, but then when you go and look at crypto exchanges, they're not trading at $1. During times of stress, they might start trading for less than $1. And what maybe people don't really realize with stablecoins is that there's a primary market and a secondary market. And when it comes to actually being able to go to the stablecoin issuer and get $1 from them for the stablecoin that you're holding, only a limited number of actors are allowed to do that. The rest of retail needs to operate on the secondary market. And so I think really bringing these together and understanding the risks there for retail users who can only redeem stablecoins on exchanges is pretty important.
And what is your confidence that the industry can help lead on that front?
Well, I think part of it is acknowledging these risks. So far, I think industry has, the crypto industry in general, has tried to sort of paint a very rosy picture. And I think it's important to be honest about the risks so that we can be honest about how to mitigate the risks. And that's another place where academia can help.
I love that. Someone who is talking sensibly about what can happen moving forward with crypto and crypto regulation, especially when it comes to stablecoin. Neha, really appreciate your joining us today. Neha Narula is director of MIT's Digital Currency Initiative. That does it for this week's Bloomberg Crypto. Please join us again next week. Tim Stenovic will be back and we talk a little bit more, and hopefully there's some more price action to discuss here, especially as we see these altcoins struggle in the wake of the the crypto crash that we saw on Friday and over the weekend. Here's a glimpse at what Bitcoin is doing today, currently down 1.7%, even as stocks hold on to their gains, the S&P gaining 0.6%. This is Bloomberg Crypto.